You're seeing the headlines, right? All this talk about the economy, potential tariffs.
Yeah.
It kind of makes you wonder how it's all going to affect your own wallet.
And the stores you go to every week. Yeah.
Exactly. You want the real story, the quick version, without needing, a finance degree.
Well, that's exactly what we're aiming for today.
Good.
We're going to take a deep dive into three of the biggest names out there: Costco, Target, and Walmart.
Yeah.
We've pulled their numbers basically from 2021 right through to 2024.
So recent data.
Yep.
Yeah.
And the idea is to get past the noise and really see how they stack up based on the facts, their strengths, maybe some weaknesses.
Right. We're not just guessing here. We're looking at specific things like how solid are they financially? Are their sales actually going up?
How much money are they making per share? Is that growing?
And critically, how does the market value them right now? Is the stock price, justified by the earnings?
Exactly. We'll look at their assets versus their liabilities. That's like their financial backbone.
Yeah.
Then revenue trends, revenue growth, are they expanding? Profitability, we'll use earnings per share, EPS, for that.
And how fast that EPS is growing too.
Crucial. And finally, valuation, the price to earnings or PE ratio.
So the mission here is to give you a clear, data-backed view of these retail giants and maybe flag some potential hurdles they're facing.
You should walk away with some solid insights into the retail scene.
All right, let's jump in. Financial strength first. Makes sense, right? A company needs a solid foundation.
Definitely. You want more assets than debts.
So we've got the assets to liabilities ratio here. For Costco, let's see, start at 1.44 in 21, ended up at 1.51 in 2024.
Okay, slight improvement overall.
Target, 1.31 back in 21, finished at 1.34, also a little bump.
Pretty stable then.
And Walmart, they were at 1.60 in 2021, and interestingly, right back at 1.60 in 2024.
Huh. So Walmart's holding the highest number, and consistently, too.
Yeah, seems like it. Like having more in the bank compared to your credit card bills, right?
Yeah.
Shows who's maybe in a stronger spot.
Exactly. And generally, a higher ratio is better. It suggests more resources, less risk, maybe. They're all above 1, which is more assets than liabilities for all three.
But Walmart stands out.
Yeah. For that consistency at the highest level over the 4 years, I think they take this one. So first point to Walmart.
Okay, Walmart, 1, others, 0. Got it. Now, let's zoom out revenue. Total sales.
But big numbers.
Yeah, and combined, these three are huge. They went from about $874 billion in sales in 2021
Wow.
to over $1 trillion in 2024.
That's some serious growth for the sector overall.
Definitely an expansion, but individually. Costco looks like it had a really strong, steady climb.
Yeah.
$195 billion up to over $254 billion.
Nice upward trend there.
Target, though.
Yeah.
Well, they had a bit of an increase early on, but then kind of flattened out. Ended around $106 billion.
So not much growth there recently in terms of total dollars.
Right. And then there's Walmart. I mean, just different scale. They grew substantially and steadily from $572 billion up to almost $681 billion.
Yeah, they're just the dominant force in terms of sheer size, and looking at these numbers, pretty reliable revenue growth in, absolute dollars.
So for that stability and just the massive, consistent revenue.
I think we give another point to Walmart. They really anchor this group in terms of revenue.
All right, 2 points for Walmart now. But hold on, total sales are one thing. How fast are they growing those sales? That's revenue growth, the percentage change, right?
Good point. Yeah, the rate of growth matters a lot.
Okay, so over the last 3 years, average growth. Costco comes in at 9.20%. Pretty healthy. They had a big jump in 2022, over 15%.
That's strong growth.
Target's average,
Uh-oh.
only 0.20%. And they actually went backwards in 23 and 24. Negative growth.
Oof. Yeah, that's a concern.
Walmart's average growth, solid, 5.94%. Consistent.
Okay, so Walmart's absolute dollars are huge and growing steadily, but Costco's growing faster on a percentage basis.
Right. Doesn't that suggest maybe more momentum, attracting customers faster or getting them to spend more?
That's a really sharp observation. Yes, while Walmart's scale is impressive, Costco's higher percentage growth definitely highlights their ability to expand sales quicker relative to their starting point.
Yeah.
It suggests, strong demand, good customer loyalty maybe.
So for the highest average growth rate.
Point to Costco. Absolutely. Got to reward that momentum.
Okay, score check. Walmart has 2, Costco now has 1. Target still on 0. Let's shift to profitability. Earnings per share, EPS.
How much profit per share of stock? Key metric.
Right. And interestingly, back in 2021, Target actually had the highest EPS, $14.10.
Oh, interesting. Higher than the others then.
Yep. Costco was $11.27, Walmart way lower at $1.62, though that reflects their share structure too.
Okay, so for that snapshot in 2021, highest EPS.
Point to target, gets them on the board.
But, 1 year is just the snapshot. How did it look over the whole period? Consistency matters.
Good point. Let's see, Costco showed a really steady climb in EPS. Ended 2024 at $16.56. Consistent upward trend.
Okay, that's what investors like to see.
Target. Well, after that 2021 peak, their EPS really dropped in 2022. Big time. And it's been a bit up and down since. Volatile.
Not as stable then.
And Walmart. They've also shown a good upward trend, pretty steady. They increased to $2.41 by 2024.
So both Costco and Walmart showing positive trends, but Target seems more erratic after that initial high point.
Yeah. So if we're looking for the most stable, consistently growing EPS over the whole 4 years.
I'd lean towards Costco there. That steady climb is quite impressive.
Okay, another point for Costco.
So that ties them with Walmart at 2 points each. Target has 1.
Right, neck and neck between Costco and Walmart. Now let's look at the growth rate of those earnings per share. How fast is EPS increasing?
Right, the acceleration of profit per share.
Okay. Costco's average EPS growth over the 3 years, 13.77%. Pretty strong. They finished strong in 2024 too, almost 17% growth.
Solid. Consistent with their revenue growth story.
Target's average. Again, not great. It's actually negative 3.00% on average.
Yeah.
That big drop in 2022 really hurt the average.
Yeah, that volatility is showing up again.
Walmart, though, check this out. Their average EPS growth is 16.02%.
Oh, so slightly higher than Costco's average?
Yep. Just edges them out on the average over the 3 years.
That's interesting. Despite Costco's steady EPS climb, Walmart's growth rate, especially bouncing back in 23 and 24, was very strong on average.
It seems like it.
Okay, this is a really important one. Profit growth fuels future potential. Given its significance and Walmart having the highest average, I think we need to weight this one heavily. Let's give 3 points for the highest average EPS growth.
Wow, 3 points. Okay.
So that goes to Walmart.
All right, let's update the tally then. Costco has 2 points, Target still has 1, and Walmart jumps ahead with 5 points.
Puts them in the lead as we head into the final category.
Valuation, the price-to-earnings ratio, the PE ratio.
Basically, how much are investors paying for $1 of the company's earnings?
Right. Lower PE might mean it's cheaper, a potential bargain, or it might mean investors don't expect much growth.
And a higher PE often means optimism, high growth expectations, but also maybe it's overvalued, right? Riskier.
Exactly. So the current numbers, Costco's PE is pretty high, 57.14.
Whoa, okay. That's up there.
Target's significantly lower, 10.90.
Big difference.
And Walmart is also kind of high, though not as high as Costco, 39.46.
Okay, so this really paints a picture of market expectations, doesn't it? Target's low PE might suggest, like you said, more muted expectations from investors.
Seems plausible, given their recent growth numbers.
Whereas Costco and Walmart, with those higher PEs, investors are clearly betting on future earnings growth. They're paying a premium now for what they hope comes later.
So based purely on having the lowest PE ratio right now.
You'd have to give that point to Target. It's the cheapest relative to current earnings.
All right. Okay, so if a stock like Costco or Walmart has a high PE, how does it usually correct itself? How does it get back down to a more, quote-unquote, normal level?
Well, there are basically 2 ways, assuming the market wants it to normalize. Either the price comes down.
Meaning the stock price drops.
Right. Or the earnings goes up significantly while the price stays roughly the same.
Okay. And since predicting stock prices is, well, impossible.
Let's focus on the earnings side. What kind of earnings growth would they need to justify, say, a PE of 20 if we hold their current stock prices constant?
Right. So you did the math on that.
Yep. For Costco, with its current price around $977 and EPS of $16.56, to get to a PE of 20, its EPS would need to skyrocket to $48.85.
Wow, that's what, like 194% increase?
Roughly, yeah.
Yeah.
A massive jump. And for Walmart, price around $95, their EPS would need to hit $4.75.
It's about a 97% increase, still huge.
Exactly. It just highlights how much future growth is already baked into those current stock prices.
Okay, so if those huge one-year jumps are unlikely, what if they just keep growing their earnings at the average rates we calculated earlier? How long would it take for the PE to naturally drift down to 20?
Right, that's the next logical question. Assuming the stock price stays put, which is a big if, but just for estimation.
Okay.
For Costco, growing EPS at their average of 13.77% per year, It would take roughly 8 to 9 years for that PE to come down from 57 to 20.
8 to 9 years. Yep.
And for Walmart, with their slightly higher average EPS growth of 16.02%, it's quicker, but still significant, around 4 to 5 years to get from 39 down to 20.
Okay, wow, that really puts it in perspective.
It does, and it brings up a critical question for you, the listener. Are you comfortable tying up your money for potentially 4, 5, 8, 9 years, just
Right.
waiting for the valuation to maybe look more reasonable?
Assuming the growth holds and the price doesn't drop.
Exactly. Or are there maybe other places to invest where the opportunity might look, more attractive right now or over a shorter time frame?
And it's not like the path is guaranteed smooth,
Yeah.
right? We identify specific issues. Target's got that low, kind of choppy growth problem.
Big challenge for them.
And Costco and Walmart, while growing better, have this valuation hurdle. You're paying a lot today for tomorrow's hoped-for earnings,
Precisely. And then you layer on the external stuff we mentioned at the start.
like potential tariffs, higher costs.
Yeah, if those things happen, they could squeeze profit margins, hurt EPS for all three of them. That could push out those timelines for reaching a PE of 20 even further.
Making those high PEs look even more precarious.
It definitely adds another layer of risk and uncertainty. So looking at all this, it might suggest that, maybe looking elsewhere for investment opportunities could be a prudent thing to consider.
So let's try and wrap this up. Our deep dive showed, yeah, each company has its moments. Walmart strong on several metrics, Costco showing great growth rates, Target winning on initial EPS and current PE.
But significant challenges remain. High valuations needing years of sustained growth for Costco and Walmart.
And just sluggish, inconsistent growth for Target.
Right. So being well-informed here isn't just about the surface numbers. It's about understanding what they imply for the future.
Definitely. Which leads to maybe a final thought for you to chew on.
Given everything we've discussed, the numbers, the valuations, the potential headwinds like tariffs, what else might be really important to consider? Are there factors beyond these financials that could sway the long-term outlook for these guys?
Or maybe tip the balance towards looking at completely different kinds of investments.
Yeah. It makes you think about your own investment timeline, doesn't it? And how important it is to look at things from, multiple angles before jumping in.